Hello and welcome back everyone. I am CA Harsh Mehta and today we'll discuss about the new IPO hitting the street, Gland Pharma. It is a company incorporated in 1978 and deals in the business of high quality complex injectables. It is bringing a rupees 6,500 crore IPO and 81% of which is offer for sale by existing shareholders. That is, 81% of the proceeds will not reach the company and go into the pockets of the existing shareholders who are offering shares. The injectables business needs a lot of technical know-how and is of complex nature. And so it is believed by the management to have virtual barriers of entry for the new entrant in the industry. It is promoted by Fosun Singapore, who is also major shareholder of the company, holding 74% of the pre-issue shares and 58% of the post-issue share capital. Fosun is a pharma company which has its roots back in China, so technically it is a Chinese promoted company. The company majorly targets the B2B business model and has exports to about 60 countries. Almost 70% of its total revenue of the company are from USA. So it is susceptible to forex fluctuations and export-import policies of both the countries, which can have a major impact on financials of the company in case of any adverse changes. Top 5 customers of the company account for 44.5% of the total revenue. This shows that it relies a lot over a small group of customers for a big chunk of its revenue, which could prove to be risky in the long run. Also, 99.64% of the total revenue of the company comes from the injectables, and so there is only one segment in which the company operates, and this leads to of technological changes. If the technology changes and or there is any substitute available in the market, then the company will nosedive and lose whole of its business, which is a big risk. The company imports its raw material through mainly China and has over-reliance on China in this matter. As seen in the recent past, if we see any change in government policies in relation to imports from China, it can adversely affect the operations of the company. The objects of this issue for the remaining 19%, because 81% is the offer for sale by existing shareholders, is that 19%, that is about 1,250 crores, will be used for working capital and capital expenditure of the company. Now let's discuss about the financials of the company. The company's revenue from operations has been increasing at a CAGR of 20.75% for the past 3 years and stands at rupees 2,633 crores as at March 2020 and rupees 884 crores for the quarter ending June 20. The profit after tax of the company has been growing at a CAGR of 47% for last 3 years and stands at 767 crores for March 20 and 312 crores for the quarter ending June 20, which is quite good and shows that it is growing at a phenomenal rate and is expected by the company to grow at the same rate in the near future, which is good for the company. The major cost of the company are its raw materials, which are mostly imported from China through its other sister concerns and accounts for about 35% of the revenue from operations of the company. So, raw materials make up the most of the cost for the company. The company has no debt and its balance sheet is so fully funded internally, which is a major advantage to the company. The company's cash flow from operating activities is improving year on year and is comfortably positive. That is, it is capable of funding its own growth and does not have to rely on the external financing, which is good for the company. The company carries a high inventory balance, which is majorly comprised of the raw materials, which can be bought down to free up the working capital and unnecessary tying up of funds in working capital. The company also has a very high trade receivable balance and allows a credit period of between 30 to 120 days to its customers. And because of this high inventory and high trade receivables, the company has an operating cycle of 200 days. That is, if money is spent on raw material today, it will come back to us in the form of revenue after 200 days. All of these leads to high working capital requirements, which is a major pain point for the company. The company has a net worth of rupees 235 as at March 2020, and considering the upper band of rupees 1500 for the share, it has a PE of about 30. Now, the company does not have any direct comparable company in the industry, but as compared to the normal pharma industry, the valuation seems to be a bit on the higher side. One more thing to note is that the company has outstanding ESOPs of almost 0.92% of the post-issue share capital, which are going to vest up to March 2020 and are priced at rupees 542. The total number of ESOPs is a bit on higher side and will dilute the company value further in future. So this was all about Gland Pharma. The issue is going to open on 9th of November and close on 11th of November. Grey market premium as on close of 4th November was standing at rupees 170, which is 11% above its asking price. But it is quite volatile and bound to change till the issue closes. In my personal view, though the company is showing strong growth, the valuations are on a higher side, and I don't expect a abnormal listing. One might see a 5 to 10% premium on listing, and so it's a avoid for me as there is no room for much of upside. Thanks.